Do you know why you don't have $1 million in your bank account? It's not because you're not working hard enough. The reason is that you don't know what you need to know how to make $1 million. Well, not after this video. Welcome to 5-Star Finance. Why get as early as possible into the stock market? The world is riddled with people who started on a low but ended on a high. Someone has to do it. Why not you? The earlier you start, the better the success rate. And to speak in stock language, the earlier you start to invest your money into the market, the more likely you are to stack a big fortune for yourself. Well, we all know that the early bird gets the worm. The more time you spend in familiarizing yourself with the market, the better the understanding of the stocks, and ultimately, the greater chances for you to hit the jackpot. Investments that are considered risky mostly lead to a higher monthly return, and for that, you need to have some experience. Starting early allows you to go that extra mile. You will have the leverage to make mistakes, learn from them, and grow over time. When you start at a young age, compounding plays a vital role in generating your wealth. If you start off by investing small sums, it can generate a great fortune for you while you're still young. Compound interest. There are two types of interests an investor can come across: compound interest or simple interest. The simple interest revolves around the basic principle, while the compound interest is something that most investors rely on. Interest on interest on interest, or you can term it as the compound interest. This is a big deal in the market. For example, if you invest $1,000 in the market, by the time you come back the next year to invest another $1,000, now the $1,000 you invested has compounded into $1,070. It is almost magical money. It gives you exponential growth over the course of long years, and your money grows faster. Let's just say you're investing in the S&P 500 Index Fund. Over the term, the S&P Index Fund has a return rate of 7% when adjusting for inflation. And when you reinvest your dividends and also adjust for inflation, it will give you a return rate of 8.5% annually. If someone's been working for 5 to 10 years, investing 20% of their earnings can be more than realistic, especially when applying personal finance methods to 5-star their finances. Now, here comes the math. If someone earns $60,000 or $70,000 annually with no knowledge or personal finance methods, to pass the 1 million mark, it's going to take that person 26 years. And to pass the 2 million mark, it's going to take you 34 years, 8 years from your previous million. The growth is exponential, and the graph gets steeper and steeper by the time. Obviously, the question over here remains, what if we're not able to earn more than $60,000 or $70,000 annually? What if we cannot invest that $10,000 required? The answer to these questions is simple. If you can somehow take your work at the next level, if you can somehow work that extra day, if you can run that extra mile, or if you are simply willing to make millions, then this should make sense to you. You just need to put your money in. It's not about the amount of money you're investing, it's about the patience you can show. The greater the patience, the heavier the return. Tracking your progress is an essential component to your journey to the success in the market. Well, some people might say that the compounding can take place in the bank as well. You can put your money in the bank and it can compound over time. But that's not how it works. It is not going to be productive over time. You can't just put your money into the bank and hope to become a millionaire in the long run. So the best way to make use of the compound interest is through investing in the stock market. So if you're having a stable return rate of 8 to 10% in the stock market, compound interest, if used patiently and intelligently, can pull off wonders for you. Albert Einstein describes that as the 8th wonder of the world. He who understands it earns through it, and he who doesn't pays it. Surely you don't want to be on the paying side as far as compound interest is concerned. The three factors: time, monthly contributions, and rate of return. Growth can be painful, but not as painful as staying in the same place throughout your life. Small numbers are not liked everywhere, but they are in the stock market. For example, if you just start off on your investing journey and you invest a good $10,000 of your earnings in the market, the company you invested in pays you a stable dividend. You reinvest in the company, and the price of your share simply grows over time. But this is comparatively difficult for someone who's just stepping in. First, earning and saving up to $10,000 is not everyone's piece of cake, to be honest. So, what if you revert to saving on a monthly basis? What if you invest $100 on a monthly basis? With a 20-year investment perspective in mind, it's going to be a bumpy ride, but long-term investments can be productive up to a significant extent. Let's just say that the stock you bought goes up one year by 5%, comes down the next by 8%, but if you rebuild steadily, it can fluctuate to grow 11% in the next year. But one thing is for certain, after the course of 20 years, you're going to come out more productive than what most safer options have on the plate. The rule is simple for investing. Playing it safe will come at a price, but taking risks will certainly end being big. Time plays a vital role as well. Suppose you're buying stocks on a monthly basis. You're investing in a certain amount every month. That means you're buying stocks in good as well as bad times. To put things straight, the stocks you buy during the good times of the market will end up benefiting you, and in bad times, the value of your shares decrease. Assume you bought stock for $40 per share. You bought 3 shares for $120. Now, if the stock did well that year, the stock price went up. Let's just say the share is now standing at $45. It works well in your case. The previous shares you bought have elevated to $45. And if the compounding happens once that year, the game has completely worked in your favor. This is if the stock did well. But what if you struck with a loss? If the stock goes down, the price gets discounted. That means you could buy more stocks for that $100 you invested. Assume the stock's price is now standing at $20 per share. That means you can now buy a complete 8 shares for that price. Imagine that you now have more shares than ever, and in the best case scenario, the price of your stock goes up. Then it's game on. You've quadrupled your share's price. This is how monthly contributions work in your favor. Many stocks also give dividends. That means you'll earn dividends in good as well as bad times. That can ultimately boost your earnings, and in the long term, this can help you in buying more shares. Shares which are costlier are likely to help you make stacks. Now, let's assume you have the patience and the discipline to check for the time and monthly contributions. To speed up the process, you would need the highest rate of return possible. And one of the best ways to do that is to pick the best stocks which outperform the market. How to invest in the stock market? Price versus value. Understanding the concept of price and value is very important to analyze stocks. Investing in the stock market depends on your ability to analyze stocks. The better your analysis, the greater chances for you to come out with the win. Price is the amount that the market wants from you, and value is the price you determine what it's worth. Intrinsic value is something that tells you about the original and true value of a stock. This is the actual value of the stock, not the market value of the stock. Broader understanding of companies enables you to make better decisions in the long run. How much is the company worth? You can't just step in the market and buy everything the market wants you to buy. Looking for the actual or intrinsic value of the company is pertinent for success. For example, if you want to invest in a company, let's just say that the company you want to invest in manufactures electrical appliances. For you to judge whether the company is profitable or not, you'll need to predict whether the service they're providing is going to be demanded or not. Another option is to depend on the analysis of different stock experts. You'll also need to see if the company you're investing in has any debt or not. Companies with greater debts are likely to undergo shallow waters in the future. But before you start analyzing stocks, you must know that there are 6 different stock categories, and the approach to analyze each of them is different. Get our free ebook by clicking in the link in the description to make sure you don't start off the wrong way. So, how do you plan on going about your investing journey? Are you planning to go for monthly contributions, or do you plan to save annually and then invest? Let us know in the comments section below. Check out this video we handpicked for you, and we'll see you in the next one.